From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views. Today, we're going to discuss some developments in the area of global information reporting, both in the U.S. and globally. I'm joined today with Denise Hintzke, who leads Deloitte's Global Information Reporting practice, along with Jonathan Cutler, who is a senior manager from our Washington National Tax practice, also specializing in global information reporting. So Denise, I'm going to start with you. We've had some new legislation this year around global information reporting. Tell us a little bit about that.
That's correct, Carrie. The U.S. passed the Infrastructure Act last year, which expanded the definition of brokers for purposes of 1099 reporting, and also added new cost basis reporting requirements for digital assets. In addition to this new reporting, which is actually rumored to be on something called a Form 1099-DA in the future, brokers are also going to have to provide transfer statements when assets are moved from one broker to another or to and from outside wallets. The act also included a requirement for businesses to report when there is a transfer of digital assets with a value that exceeds $10,000, similar to what we have with the Form 8300 reporting that exists today for cash deposits or payments over $10,000. So this is legislation that was actually needed in this space, particularly because there were some concerns that people that were invested in cryptocurrency were not getting the information that they needed to be able to properly report the information on their tax returns.
Got it. So those new reporting requirements are now in place. What do we expect next?
I think we can expect a few things. First of all, the statutory effective date for some of the crypto reporting requirements that I just mentioned is January 1st, 2023. But it's going to be tough for those requirements to move forward without regulations that provide the details around the who, what, and how of the particular reporting. We're likely to see these regulations come out very shortly. Secondly, the reporting rules are currently only focused on U.S. investors in crypto assets. Treasury addressed some of the rules that would be needed to close the holes with respect to foreign investors in the 2023 Green Book. We're likely to see a number of these provisions also show up in future legislation. In the absence of that, there will definitely be a hole in the rules. Finally, there are some indications that the U.S. may participate in the OECD crypto asset reporting framework, so we need to stay tuned there as well.
Got it. So Jonathan, maybe you can walk us through what these regulations might include.
Thanks, Carrie. One of the points I'd like to make is these regulations could hypothetically include a delay. We've certainly heard plenty of rumors around the industry as to whether Treasury is going to choose to delay or not, whether Treasury is constrained by this effective date that Denise already mentioned. Here we are approaching year end, no regulatory clarity, and we have included in the rules a 1/1/23 cost basis tracking requirements. That's very concerning for industry who's still scratching their heads saying, am I in? Am I out as a broker? What digital assets are in and out? What is the true scope of these rules? I need clarity before I know what to track cost basis on. So that's the first point, is we may see a delay or not. We'll just have to wait and see. Denise already rightly mentioned that we expect these regs by year end. That statement has been made publicly multiple times by members of IRS Chief Counsel's Office and Treasury. We know regulatory approvals take a long time, so we're certain there's something drafted out there. To your question, Carrie, what do we expect them to contain? There's a few things we know and a few things we don't quite know, but we'd like to see clarity on. So let me talk through a few of those. One, we know there will be a focus on sales, not retail payments. Denise laid out for us 60/45 reporting of digital asset sales by brokers, 60/45 Cap A, which is the new transfer statement reporting when you transfer your digital assets off platform, and then 60/50I, this reporting of crypto as cash equivalents in a retail context. We have heard publicly stated 6050I is going to require coordination with FinCEN, which is the regulatory body also in charge of this Form 8300 reporting. Banks have to do this when you come with cash today. Retailers have to do it when you come with cash in a suitcase type form over $10,000. We expect that coordination will take longer than we have for the reporting. What we don't know is what will the regs do with 6045 Cap A. We assume the mechanics of this are a bit complex. How do I identify when I transfer from a broker to a non-broker? Will we see something like we see in the FATCA world, where there's an FFI registering for a global intermediary identification number? Perhaps they consider some way of identifying brokers through a similar registration number. Perhaps there's a different mechanism for identifying. That's a bigger hurdle, we think, than the possibly more straightforward rules of saying, here's how you report your digital asset proceeds, here's how you track basis. We also, to that point, know there will be information on covered versus non-covered securities. In the current securities world, when you acquire stock for cash in an account after a certain set date, it is treated as a covered security. You have to report what you paid for it. That reporting of cost basis, what you paid for it, and when you acquired it, is only required for the covered securities. We see the statute already amending the covered security definition, amending specified security to include digital assets. What we don't know is, will there be a delay on the covered security date? So right now we have reporting phasing in 2024 on 2023 activity, but we have covered definition kicking in January 1st, 2023. Could we see a delay of the covered component? Possibly. We'd like to see from these regs. We also know there's a lot of details folks are looking for in lot selection. I'll use that term. It's a securities term. In the crypto world, lots are not really a term we would use, but we know customers are going to want to say whether they're selling their low basis, high basis, or some other basis asset. They want to be able to identify before their broker trades with it. We know it will have to address that. What we don't know is, in what way will the rules address this lot selection method? Will they choose to retain the structure we have today, allowing you to notify your broker before the sale occurs? In the context of securities, we have a settlement period. There's not really a settlement period in the digital asset space. So how will they address that timeline between when I put my orders in and when I need to specify the lot I meant to sell? We'll also be curious to see how they deal with crypto to crypto exchanges, which adds just some complexity in this world. We use this term fiat, that's cash currency. When I'm trading my crypto for fiat, it's reasonably easy to identify, here's what I bought it for, here's what I sold it for. There's actual cash in the account. What about crypto to crypto? That adds some wrinkles in the withholding space and in the cost basis space.
So lots of areas needing additional guidance. Denise, you mentioned that the OECD has released some information. Can you share a little bit more about that with us? And does it help give us ways of thinking about some of the issues that Jonathan just mentioned?
Yes, Carrie. Unfortunately, I don't think it actually deals with the issues that Jonathan just mentioned. However, OECD did just issue the final CARF rules on October 10th. This document, or these rules, actually provide a framework that's supposed to be followed for reporting and information exchange on digital assets. It also include rules for the reporting of e-money products and digital currencies that are issued by central banks. It has a very broad definition of who will be a financial institution for purposes of these rules. As a matter of fact, it pretty much pulls everybody in, with the exception of some specific exclusions that it lists. So it's all in unless they've specifically excluded you. And it has a very broad definition for what is a crypto asset as well. Once again, everything is pretty much in unless they've specifically excluded it. And these exclusions are very limited in nature. The document itself is really just the first of 3 building blocks that are being put forward and are meant to ensure the successful collection and exchange of cryptocurrency related information. So it provides the guidance around how you're going to document and identify the investors and what type of information is ultimately going to need to be reported to the regulatory authorities. But it's not everything that's needed. So in addition to the framework itself, which they just released on the 10th, OECD is also going to be providing bilateral and multilateral competent authority agreements that will actually allow for the automatic exchange of information that's been collected by the jurisdictions. So the CARF standard itself is how the jurisdictions will collect it. These agreements are how they will share it or permit the sharing. And then they're going to be releasing the schema and build the technical solution to support the actual exchange of the information. So there's a lot that still needs to be done in this space as well. Because we're still waiting for these additional pieces, and because each jurisdiction is going to need to go through their own legislative process in order to adopt CARF into law, we're not likely to see any reporting under this new standard until after 2025. But I would say, given the amount of work involved in implementing the standard, that really doesn't seem like much time. And so I think, again, industry is kind of holding their breath, hoping that there will be some type of delay with the implementation of these rules.
Lots of rules and not a lot of clarity at this point. Jonathan, maybe you can talk about, beyond the timing, what is the industry most concerned about?
Well, Carrie, I think you hit the nail on the head when you said there's a lot of rules and not a lot of clarity. If you thought I had a number of bullets, and believe me, I had more on the 60-45 U.S. reporting focus, there's so much that folks are looking for clarity on within the OECD's crypto asset reporting framework proposal. Just quick history, they released the draft in March, and industry raised some yellow and red flags as they went through the feedback process that happened in April and May. The OECD took that away and redrafted. Our latest release on October 10th was the redraft of those rules. Industry was very concerned about a few components that were removed from the final proposal. Now, it's important to note that any of these rules could be picked back up within the jurisdictions when they implement. Similar to the common reporting standard, the joke we've always made is the common reporting standard is not so common and not so standard. We could expect to see similar jurisdictional variance in the CARF space. So, for example, there was major concern raised by industry that there would be a self-certification expiration proposed in the rules. The final draft by the OECD did not include that. I'm expecting jurisdictions won't pick that up, but it's always possible that the local law could say, hey, I like that idea, let me include that. Prohibitions against trading without a self-certification form. The original March draft used very strong language saying, hey, if you have a customer who is not documented, an account holder who is trading in crypto on your platform, and you don't have the documentation we require, we will not allow you to buy, sell, trade for that customer. That strong language was pared down in the final draft because of industry feedback. There was major concern over the realities of the volatile crypto market. My customer needs to sell now, and because they haven't gotten their document through the mail, or there was something at issue with the electronic system, or maybe they were just unresponsive at first, I'm concerned about the business risk in being prohibited from trading. That's one, though, I could expect some jurisdictions, and they have already through the common reporting standard, being a little bit more staunch on, saying, hey, if you don't have the right documentation, you can't open the account, you can't trade. We'll have to wait and see. The biggest thing is for our friends in DeFi, decentralized finance. There was major concern raised that targeting DeFi, which is a burgeoning industry, if I can use that term, a brave new world, burdening them with compliance requirements, documenting customers when customer identification is not easily obtained in the DeFi space. In fact, that's inherent to the design of DeFi, is that I'm trading without intermediary involvement on a platform. Obligating that DeFi platform to add in a step that an intermediary would normally have, that being documenting the customer, is very concerning to DeFi. There's concerns from the industry that it would shut down the advantages of DeFi. It's also just slowing down business development, right? We had a number of DeFi players give the feedback that, hey, you could be giving us a competitive disadvantage here by burdening us with these overly complicated rules. We don't have the same scale that a traditional financial institution might have. The OECD did not play ball with that feedback. They clearly stated in the rules, we know more guidance is needed. They aligned more precisely with the Financial Action Task Force recommendations for AML and KYC purposes, but they did not choose to descope DeFi, stating this is an area where we see the potential for tax evasion. We know that our tax authorities that are participating in this framework care about DeFi transactions. We're keeping you in scope. It's a big question mark still what that additional guidance will say, how it will choose to apply to certain DeFi providers and not, but it remains in the rules. There's a number of other components, Carrie, but I'll stop there.
Well, there certainly was a lot there and a lot for organizations to think about. Maybe to help us wrap up, maybe I could ask both of you just to comment on what companies can be doing now, just given all the uncertainty that's out there. Denise, do you want to go first?
Sure. I mean, this reporting seems like it's a long way off when you look at both the US rules and the OECD rules, but it's going to be here quickly. And we're not in a situation where we're saying, is there going to be reporting? Instead, we're in a situation where we're saying, well, when is the reporting going to be? So I don't think it's too early for organizations to begin to look at the impact that these various sets of rules are going to have on them and potentially start to remediate if possible. This is especially, I think, in the area of documentation. Companies can begin to look at what type of information do they have about the investors, what kind of documentation have they collected at this point, is it going to meet the standards under both the US rules and or the OECD rules, and if not, start to look at how they can potentially cure those gaps.
Denise, I couldn't agree more. I'll say from the perspective of someone who banks with financial institutions and has had to provide customer account opening documentation, the less paperwork I have to fill out and the shorter and fewer touch points I have on giving you my information, the better. So I would strongly encourage organizations to consider updating your onboarding account opening documentation as soon as feasible. And by the way, despite all the complexity we pointed out, there are a number of variables that we do know that will almost certainly stay static. You know that you will always need your customer's name. You know that the tax identification number will always be relevant, whatever the TIN equivalent is in the jurisdiction where your customer is opening an account. You know that their tax residency is always going to be relevant. In the financial side of things, we've already talked about cost basis, what you paid for the asset. That's going to be relevant in either regime, with CARF choosing to report it at the time of the buy, and with the 6045 US rules choosing to capture it in broker records to report at the time of the sale. That information you can start capturing now, especially if we don't get the delay that we think might be possible from these pending regulations. I'll also quickly note that there's a withholding aspect to the US-focused rules. Backup withholding is an expensive undertaking. This is something you really want to avoid. So consider when you update your account holder documentation and account opening process, consider embedding a Form W-9 to obtain a certified TIN and avoid any possibility that backup withholding could apply to your customers.
All right. Well, thank you, Denise and Jonathan. Clearly, there is a lot that organizations need to stay close to around this evolving area. So thank you for sharing that. If our listeners would like more information, you can go on Deloitte.com and search Global Information Reporting. You can also connect to Denise and Jonathan directly via LinkedIn or tune in here for future updates. In the meantime, thank you all for joining us. Be well and look forward to talking to you in the future.